Monday morning, folks, and welcome to a brand new episode of FINMET Mondays. Last week, markets were a little bit more on the quieter side, Sunil. The events from Israel and Iran were dictating news mainly, and market participants were not really focused on what the Fed really had to say and what the data was kind of having to say as well. What did you characterize last week's price action movements as?
Yeah, I think the market is now at a crossroads, and what you have is it's a finely balanced situation right now. Maybe the risk is more to the downside, but it's still balanced. And so, let me give you a view of what the bulls and bears are feeling about the market right now. I think the bulls feel that we still have more momentum in the rally, and they would still want to come in and take it up. They feel maybe the market is still vulnerable to upside shocks, and so that's why they want to try. They'll try to see what happens to the market and try to take it up. But I think the stronger hand is probably on the bears. I think the bears had sort of gone into hiding. They got stopped out. Their shots were stopped out. They were really wounded, and so they was on the sidelines looking at seeing how much this rally can go. And the fact that we have now stabilized at the sort of 2400 level and been trading up and down $25 on that, plus the removal of this Iran-Israel fear that's there, plus the Ukraine war situation with the budget being passed for arms, I think gives reason for the bears to say, okay, right, I don't think there's that much of a upside risk, and so they'll start restoring their positions, and especially some of them who have not sold as this moved up may think of 2400 as a good level, especially if you're looking at 3 year, 4 year forwards. You're looking at 26, $2,700, which is a fairly good margin for a lot of miners. So you might see, I think, more pressure on the downside, more selling coming in the coming week. But right now, for example, for sure, we are in this balance right now. Each when looking to see who's going to make the first move.
Interesting, interesting. Even the technicals seem to suggest something very similar that we may have reached a stop somewhere around 2400 for markets to pull back and then take prices forward. Let's quickly look at what the markets have to say. So last week's price action, Sunil, can be characterized by this single candlestick chart alone. What we have here is the weekly US spot gold chart. And what we can see is this 2322 support, which we had said last time was from where markets are going to bounce back. That level was tested. And we did see a pullback in the positive direction, right up to the 2400 resistance right here, where you did see the markets test this resistance, stay for some time around 2410, 2415, but was not able to sustain those high levels and immediately saw a pullback. Now, this range from 2400 to 2322 is what looks like to be the range for the next week as well, given all the conditions remain the same. However, if we do see some escalations from the Iran-Israel conflict, this 2400 resistance will be the first one that will be tested. And you will also see then the 2454 level, which is the next major resistance, might also be tested. There is no upper limit going forward, as we already know, but this will probably be the first intermediate resistance that gold will have to breach. On the downside, after 2322, the first intermediate support is on 2256. Now, participants are also interested to know if there is a little bit of a subdued action in these geopolitical developments. What are the markets then going to lean towards? What is the next instinct, or what's the next sort of the sentiment that people are going to head towards? And I think strongly that they might then go back to looking at what the interest rate cut policy cycle from the Fed looks like. If you look at the CME Fed Watch tool, 16.2% is what the probability of a rate cut in June looks like to be as of today. As compared to when we go to July and we go to September, you see that there is a slightly higher probability of a rate cut as we progress to these months. So I think participants will then try to consider these factors as well, thinking that, oh, we're much further away than what we initially thought we were in terms of getting an interest rate cut cycle. And there will be a repricing of gold, and there'll be a slight consolidation phase that gold might go through once the geopolitical conflicts are slightly subdued and participants turn their attention away from them. One another interesting development that I came across is looking at the margins that are currently being charged and how that has changed over the last 2 months, especially on the CME futures. So as of today, the margin is currently at 10,000 USD. But a quick look at the historical margins that, or the maintenance fees that CME charges for you to hold a position, it was about 8,800 just 15 to 20 days back around the 1st of April. And if you scroll further back, it was about 8,300 not too far away, somewhere around the 8th of March, right over here. So you can see that just in these 2 months, how the margins have increased just to ensure that the volatility is curbed. There's a limit on the amount of speculative action that can actually go through. And this is kind of also playing into the fact of how the volume and the open interest of the futures contract for gold is also playing about. You see that in the last week, we are seeing a consistent dip in volume, although not that significant. It is kind of regressing to the mean, but there is a slight dip in the volume, although open interest has remained fairly flat and it's even increasing. What this indicates, what this tells us is that there are still a lot of open positions that are currently, due for closure in the markets, but you are slightly seeing a little bit of reduction in the new contracts or the fresh volumes that are being traded. So this is kind of as an update on the CME futures of what's happening as well. Looking forward to next week, we have the PC price index reading. This is the Fed's preferred gauge of inflation. Across Jan and Feb, the PC inflation has come on a year-over-year basis at 2.4%. Participants will be looking to ensure that this inflation reading remains consistent, because this will allow for gold to cut rates faster. But if a reading above 2.4% comes, it will play into that entire story again of the fact that you might see a correction into gold, because this is not good for gold, that inflation is still very sticky. Well, thanks, Neil. That broadly summarizes what our outlook is for the coming week. Let's look forward to see how the market shapes up. But till then, thank you so much and goodbye.